Hello, can you hear me?
Yes,
All right.
yes, we can.
Okay, good evening, guys. Today we want to talk a little bit about financial reporting analysis. We are talking about
Yes,
ratio.
we can, James.
Sorry? All right, so we want to talk about ratio analysis today. All right, so just give me a second here. Let me see if I can get your study guide nearby. Financial, but we don't really need it. We just want to discuss a little bit. It's a very straightforward topic. All right, it's fine. Let me just discuss it with you. Couldn't see your study guide there. All right, so when a business is operating, right? Remember we talked about the financial, and we said that a business has got an income statement, a statement of financial position, and it also has got a statement of cash flows, right? Which shows what the business has done over the last year. So the income statement shows us the income that the business has made, i.e. the profit and the loss that the business has made over a specific period of time. Then the statement of financial position shows us the value of a business on a specific day. That is, what are the assets, what are the liabilities, what is the equity of the business, right? Then the statement of cash flows shows us what is the cash flow that the business has made over a specific period of time, right? So that's what we have in terms of the financial statements of a business, right? But as a manager, or maybe as an investor, if you look at the financial statements of a business, it is very, very difficult for you to interpret them. So, for example, if you look at the financial statements of Vodacom, you might see that it is in the billions of rands. But if you look at the financial statements, maybe of a smaller business, maybe the business is called Yusuf, right? You might see that maybe it's in the millions and it's not in the what? In the billions. So that difference between the businesses, that one business is in the billions of rands and one business is only doing millions, can make it difficult for you to see which of the two businesses is performing better. Because just because a business is making R1 billion does not mean that the business is a better business in terms of profitability of that business. For you to be able to do that, you need to size up the business. We call it same sizing. You need to size up the business. That way you can compare the businesses that are doing the billions and the businesses that are doing the millions. Your ability to compare these two businesses is based on the what? On the ratios that you can calculate for the businesses. So there are different types of ratios that you can calculate in each and every business. There are profitability ratios, there are efficiency ratios, there are shareholder ratios, there are debt ratios, and there are liquidity ratios, about 5 groups of ratios. You can go through this in your study guide in your own time. You can read through these notes. I'm not going to go too deep into it, right? So these ratios, they're basically showing you a different part of that particular business. That's what they're showing you. So for example, if you're looking at profitability ratios, they're just showing you whether a business is making a good profit or whether it is not making a profit, right? If you are looking at efficient ratios, they're just showing you how efficient or how effective the business is in utilizing the assets that it has, in utilizing the capital that it has. If you're looking at liquidity ratios, you're basically looking at how liquid, short-term liquidity, is the business able to pay its creditors? Is the business able to pay its short-term liabilities? If you're looking at shareholder ratios, you're basically looking is what is the return that the shareholders are getting on the funds that they are investing into the business. Then if you're looking at debt ratios, you're basically asking yourself, how much debt or how much money did the business borrow? So because when you're using ratios, it doesn't matter whether the business is worth 1 million or it's worth $1 billion, the ratios will be the same. So if you calculate the ratio for yourself, for liquidity, and you get 1:50, and then you calculate the ratio for $1 billion company such as Vodacom, and you get 1:50, which means that those companies are performing the same in terms of liquidity. Which means although there are different values in terms of the overall company, but in terms of liquidity, both companies are at the same levels because their ratios are the same. If the other company has got a better ratio, it means it is performing better or it is being managed better than the other company. Right. So when it comes to ratio analysis now, I'm done with the theoretical aspect, right? The list of ratios, study guide, you can go through them or not, it doesn't really matter. Right? But when it comes to ratios, when we're looking at the exam, there are two things that you need to know. The first thing is how to calculate the ratio. The second thing is how to interpret the ratio. So those are the two things that you need to know: how to calculate the ratio and how to interpret the ratio. So let's start with interpretation, because that is something that you might struggle. Calculation is very straightforward, you will see. But interpretation is something that you might struggle with. So with interpretation, when you are trying to interpret whether a ratio is good or whether it's bad, there are two ways to interpret a ratio. You can either do what is called trend analysis, or you can do what is called comparative analysis. Trend analysis is where you are looking at the ratios of the company over time. You are asking yourself, what was the ratio last year and what was the ratio this year? Has the ratio improved or has the ratio declined? Right. So if it is improved, then you comment, oh, the ratio last year was 33%. This year it is 45%. Therefore, there has been an improvement in the performance of the company because the ratio improved. So that's trend analysis. Right? Then the second way to interpret a ratio is comparative analysis. Comparative analysis, either you can compare against another company, or you can compare against what is called a benchmark or an industry standard, right? So when I say compare against another company, I'm saying, for example, if we say that the net profit margin ratio, which is profit, right, is 20% for company XYZ, then you can check what is the net profit margin for company ABC. If for company ABC it's 19%, then you can say company XYZ is performing better than company ABC. But if for company ABC it's 30%, then you can say company XYZ is performing worse than company ABC. You are comparing two different companies to see which one has got the better ratio and which one has got a worse off ratio. So that's comparison when you're looking at companies, right? Then comparison, you can also look at a benchmark. A benchmark is we can look at the whole industry and say, in the telecommunications industry, what is the best ratio for profit? And we can say, on average, we believe that if a telecommunications company is making 15% net profit margin, it's a good company. Then any company that makes more than 15%, we can conclude that it is performing better. Then any company that is making less than 15%, we can say it's a worse off company. So that's comparison based on a benchmark that you have and say, this is the benchmark ratios. Now, benchmark ratios, either your lecturer can provide you a benchmark ratio. If he does not provide you a benchmark ratio, there are only maybe two ratios that we know of that are benchmarks already without being told. So that is the liquidity ratio and the acid test ratio and the current ratio. Those are the only ones that have standard benchmarks across every industry. But all the other industries, you have to be told what the benchmark is for you to do a benchmark comparison. Right, so that's interpretation of ratios, right? So now let's go through our examples here, and we can just, as we discuss, we can highlight a couple of things, right? So that's interpretation. So calculating ratios, like I said, is a very straightforward process. You don't have to stress about this one. So if you check every question paper that your lecturer gives you. At the end of the question paper, there is a formula sheet. The formula sheet has got all of the formulas of all of the ratios that are in that paper, which means that he's not going to give you a question and the formula is not on the formula sheet. So if there is a question about a ratio, the formula is obviously on the formula sheet. That's why I'm saying that it's a very straightforward process. The only issue is how do you interpret the information provided? But the formulas are already there. Then number two, if you don't understand the formula sheet, then you can go to your study guide. In your study guide, he literally tells you that this is the net profit margin ratio. And then under that, he gives you the formula. That this is the current ratio. Then under that, he gives you the formula. That this is the debt ratio. And then under that, he gives you the formula. It's just that on the formula sheet, he does not mention that this is net profit margin, this is debt ratio, because he expects that you read through the study guide and you know which one is what is which one. That's his expectation. But if you have not had time to go through the study guide, to read through ratios, you can also just use the study guide. Just check the ratio that you want. You go under the topic of ratios, you go under profit ratios, and then you can pick it up and use it. So which means in the exam, you don't need to cram the formulas. They are provided to you. So that's why I'm saying that it's a very straightforward process. But however, there are a few tricky ratios that I am going to show you that you need to be aware of how do I calculate it when it looks like this, and etc. So that's something that we are going to just shortly discuss now. Okay. So we have an example question paper here. Question number 5. It says here, using the information provided in question number 4, calculate the following ratios. And then we have a list of ratios that we have over here. Let me just copy them. All right. So that's our list of ratios. So like I said, because me over time, I already know these ratios by head. I can just use my head to do them. But you are free to use your study guide. So for example, it says here, calculate the net profit margin ratio. If you go into your study guide, you will see that there is somewhere where it's written net profit margin ratio. And then you can take that formula and use it. But if you already know, then you know that the net profit margin ratio is going to be on the formula sheet, there is the second one, which says profit after tax divided by sales multiplied by hundreds. So that's your net profit margin ratio, right? And then we're going to go into do the actual calculation. I just want to pick up the ratios. If it tells you calculate the acid test ratio, if you check in your study guide, you have the formula already for the acid test ratio. On your formula sheet, it's this one over here. That's the acid test ratio. Our current assets minus inventory. All of that divided by our current liabilities. And then you've got return on equity. Return on equity, let's see which one is it. It's going to be the net profit after tax divided by the equity. Did we have it here? I'm failing to see it. Oh yeah, profit after tax divided by equity multiplied by 100. Right. and so forth and so on, right? We're going to do the other ratios. So let's just do an example of calculation. All right. So he says use the information in question number 4. So if I go to question number 4, that's the information that I need. So if the ratio says profit after tax, it means I need to identify what is the profit after tax. Right? It's as straightforward as that. So if I go to question number 4, you can see over here, you can see over here, it says profit after tax was 1.440. So I can just write here 140,123 divided by my sales, right? Multiplied by 100. So your lecturer, because he is also trying to make your life a little bit difficult, do you notice that he did not give you what the sales figure is? There is a blank space there on the sales figure. But remember, you guys, we've been learning accounting for the last semester, right? So you know what to do there, right? So let's say workings here. Workings, right? So how can we calculate the sales? We already know that if I say sales minus the cost of sales, it will give me the gross profit, right? We know this from our income statement, that if I say sales minus the cost of sales, I get the gross profit, right? So if I get gross profit from that, which means I can use algebra to solve for this. This is an equation. So sales minus 5,304,000 is equals to 3,096,000, and then solve for sales. So sales is equals to 3,096,000 plus 5,304,000. Did I lose anyone here? I don't think so. Straightforward process, right? So which means my sales is 8,400,000. That are my sales. So which means there on my formula, I can easily write here 8,400,000. And then if I calculate that, what answer do I get? 114,000 divided by 8,400,000 multiplied by 100. I get an answer of 13.57%. I get 13.57%. So that's how you calculate your net profit margin. You're done. That's your answer, 13.57%. Again, the formula is straightforward. Profit after tax divided by sales multiplied by 100. That's the formula on the formula sheet, right? So what is your profit after tax? It's there already. What is your sales? In this particular case, he did not give us the sales, but it does not mean in every exam, he does not give you the sales. In some exams, the sales will be right there. Where there is a question mark there will be the sales figure. So you just put in the sales. But if there is a missing figure there, then you can calculate it using equations. Right? You just try to make your life a little bit difficult, but you know these things because you already know how to do an income statement. So you can reverse engineer and calculate the figure for yourself. So that's where we got our sales of 8.4, where we said sales minus cost of sales is equals to gross profit. He has given us the cost of sales. He has given us the gross profit. So I can calculate the sales quite easily. And then I got an answer of 13.57%. Right. So in addition to this, he might ask you now and say, number one, he might say, interpret your ratio. So that's what I was talking about. So if you're interpreting this ratio, if you have a ratio from last year, you can compare. If the ratio from last year was 10%, you can say this is a 13%, so there is an increase in the net profit margin ratio. Right. The net profit margin ratio represents the profit that the company is making per every rand in sales. That's what the net profit margin ratio. It just shows you the profit that you're making for the sales that you are selling in the organization. And so you can interpret and say that it has increased. if there was a ratio from last year. If there's a ratio of another company or a benchmark, you can compare with that other company or with the benchmark. If none of those things are there and he still wants you to interpret, then you go to the definition of what the ratio is. So like I said, the ratio represents the profit that they are making for every sale that they make. So you can then say this company is making a 13.57% profit for each rand in sales that they make, or for each 100 rand in sales that they're making. You can say it's good, you can say it's bad, it's really up to you if there's no information provided. But however, if he asks you, how can we improve the net profit margin ratio? That's a question that he might ask you. How do you improve this ratio? So for you to be able to improve a net profit margin ratio, it's either you're going to improve your profit after tax or you're going to improve your sales. Right? So how do you improve your profit after tax? You can either charge a higher price, which means you get a higher margin, or you can try to manage your cost so that you can reduce the cost of sales. Right? So those are two things that you can do. Or like I said, you can work on increasing your sales. If you increase your sales, maybe you get a better margin, right? But that's your net profit margin. All right. Any questions before we go to the next one? No questions. So that's fine. So all profitability ratios, if you go under your study guide and it will list for you profitability ratios. Most of them, they will tell you net profit divided by sales, operating profit divided by sales, gross profit divided by sales, something like that. But all of them, when you're interpreting them, the goal here is if you're trying to improve that ratio, if it's a profitability ratio, you want to improve a profitability ratio, you can either increase your prices or you can reduce your costs. Either increase your prices or reduce your costs. That's the only way that you can increase or improve on a profitability ratio. Right, let's go to a liquidity ratio. Right. Liquidity ratio, here we are asked to calculate the acid test ratio, right? So again, we have the formula over there, very straightforward. Current assets minus inventory divided by current liabilities, right? So it's testing your knowledge of what we've done already. So again, let's go and check the question. So in this question, do you see we've got the statement of financial position and it has got a list of assets. Do you notice the trick that your lecturer did? He did not divide the assets and say these are your current assets, these are your non-current assets, which means that you need to be able to know what your current assets are and what your non-current assets are. Remember our lesson number 1, when we talked about assets, liabilities, incomes, and expenses, and we're doing examples, we're saying, so these are current assets, these are tangible assets. That's the reason why you need to do those exercises, because they will help you to make sure that you don't make mistakes. So from these things over here, you already know that property, plant, and equipment, that's a non-current, that's a fixed asset. Long-term investments, that's a non-current, that's a fixed asset. But trade and other receivables, and then the bank, and then the inventories, these are your current assets. So if I was to ask you what are your current assets, you're going to say inventories plus trade and other receivables plus bank. Those become your current assets. So which means that if we are creating a little formula here, we are saying our current assets are equals to 2,100,000 plus 2,520,000 plus 1,500,000, and you close the bracket there, right? So those are your current assets. But the formula says those current assets, please subtract the inventory, which is 2,100,000, right? And then everything you divide it by the current liabilities. So what are your current liabilities? Again, if you check over there, you can see the little trick that he did. He did not separate for you. So which means you need to separate for yourself what are your current liabilities. Ordinary share capital, that's not a current liability, that's equity. Retained income, that's not a current liability, that's equity. Trade and other payables, that's part of current liabilities. Company tax payable, that's part of current liabilities. So, which means your current liabilities are going to be 900,000 plus 60,000. Right. So, which means you can what? You can easily calculate this. So it's going to be so our answer here is going to be equals to 4.19. So that's our ratio there. 4.19 is our acid test ratio. It's a very high ratio. Just double checking if I did it correctly. Okay, it's fine. So that's our acid test ratio. So how do we interpret this result? So, okay, some textbooks will say this. Instead of saying 4.19, it will say 4.19 is to 1, like this. So you might also notice that answers might also come like this for this ratio, 4.s to 1, or it will just be 4.19. It's the same thing anyway. So your lecturer will ask you, please interpret this ratio. So how can you interpret this ratio? Number one, do you notice that you have got data for 2023 and you've got data for 2022? Which means you can actually calculate this ratio for 2022 and then also calculate for 2023 and compare the two figures to see whether it improved or it declined, right? So this ratio, what does it represent? It represents your ability to pay your short-term liabilities. So if it is very small, it's a problem. If it is very high, that's better for you. But again, there are some caveats. We're going to talk about them shortly, right? So the higher this ratio is, the better for you as a company, right? So in short, that's how you can interpret this ratio. You can compare the 2 years, or you can check whether it's a very high ratio or it's a very low ratio. Then another way is the benchmark. Remember, I talked about the benchmark area. So the benchmark for this ratio is 1:1. That's the benchmark. If you have a ratio of 1:1, that's the perfect acid test ratio. So if it's below 1:1, it means your company cannot pay its short-term liabilities. If your ratio is more than 1:1, it means that your company can what? Can pay its short-term liabilities, right? So that's your benchmark. However, in some textbooks, they will tell you that this ratio should also not be too high. You don't want this ratio to be 10 or to be 20:1. Because what that means is that you have too much cash lying around at your company, which means you are misusing cash. You are not investing cash into productive things in the business. So some textbooks will say it should not be too high. But generally, as long as it's greater than 1:1, you are good to go at your company. If it's below 1:1, you have a problem. So that's how you can interpret the acid test ratio. Again, it measures how able are you to pay short-term liabilities. So usually, there's also what is called the current ratio. The current ratio, the benchmark is 2:1. The current ratio, the benchmark is 2:1, whereas the acid test ratio, the benchmark is 1:1. Right? So they usually go hand in hand because they measure the same thing. They measure the liquid position of the company. Right? I don't think that the only trick that is on this one is this issue whereby your lecturer might not separate for you that these are current assets and these are current liabilities, which means you need to pick them up yourself. That's the only tricky part for this particular question. The last question that we did for net profit margin, like I said, the tricky part is you might remove one figure and then you have to recalculate it yourself. Like you might remove sales, or you might remove net profit, or you might remove gross profit. You have to calculate it yourself before you do the ratio. But for this one, for liquidity ratios, the trick usually is he does not separate them for you. You have to separate them for yourself. Any questions? Any problems with this one? Anything that you did not understand? All is well. All right. Next one is return on equity. Return on equity is actually a profitability ratio. It's actually part of the profitability ratios. Let's see. Net profit after tax. We have that already, if I'm not mistaken. Yes, we have it, which is 1140,123 divided by equity. So you need to know what is equity. Equity is made up of your shareholders and your retained income. All right. So your ordinary share capital of 7.2 plus your retained income of 3 million. That's your equity. All of that multiplied by 100. So what is that going to give you? So that's going to give you an answer of 11.18%. All right. So again, same deal. He asks you maybe to interpret the. When I'm saying ask you to interpret, I'm not saying every exam he will ask you to interpret these ratios. I'm just saying it in advance. For example, in this exam, all these ratios, he just said calculate. He did not say interpret, which means you were just calculating. This answer alone is fine, but I'm interpreting them just in case you have a question where you're asked to interpret so that you can understand how you interpret. So he asks you to interpret return on equity ratio. How can you do that? Like I said, remember, he gave you data for 2023 and 2022. You can calculate the one for 2022 and compare between the 2 years. Or alternatively, if there is a benchmark that your lecturer has highlighted, that the benchmark return on equity ratio in the industry is 25%, then you can say, this company is worse off because it's below the benchmark what? It's below the benchmark ratio. Or if it does not give you both of those things, then you need to know what is the definition. So like the return on equity is the money that the shareholders are getting, or the return that the shareholders are getting on every single rand that they have invested into the business. Not dividends, remember, this is from net profit. There's also what is called a dividend per share, which is different from return on equity. Because dividend per share represents what they've actually been paid. But return on equity represents the return that they're getting, regardless of whether it has been paid to them or it has been reinvested into the what? Into the company. So that's the return that they're getting. The higher this ratio is, the better. Any profitability ratio, the higher the ratio is, the better. Any liquidity ratio, the higher the ratio is better. Any efficiency ratio, the higher the ratio is, the better the company is. So that is for efficiency ratios, profitability ratios, liquidity ratios. The higher that ratio is, the better. But the other two classes of ratios, efficiency, debt ratios and shareholder ratios, those ones, it can be a little bit tricky. It depends on what you're talking about. But these three groups of ratios, the higher it is, the better for the company. All right. So next one, we've got inventory turnover ratio. This is an efficiency ratio. Okay. Formula sheet. Inventory turnover is going to be cost of sales divided by average inventory. So how do you calculate that? Cost of sales, we already have that already. So that's 5,304,123 divided by the average inventory. So how do you do a calculation for average inventory? Just give me a second. So average inventory is equals to opening inventory plus closing inventory divided by 2. That's what average inventory is. So if we check over here, what are we told? There we go. This is where I'm looking at. So the opening inventory, it means the inventory from 2022. That's last year. That's the opening inventory. So that's going to be 2,580,123 plus the closing inventory. That's the inventory from 2023, which is 2.1 divided by 2. So that is going to give you 2,340,123, right? So that's your average inventory. So which means your ratio is going to be 2, so that's your answer there. So when you're calculating inventory turnover, your denomination is times. When you're calculating profitability ratios, you use percentages. They're all percentages. When you're calculating liquidity ratios, they are S/1 because they are literal ratios. It's 5,3 S/1, 2,5 S/1. But when you're calculating inventory ratio, your answer is in times. When you're calculating, there's debtors collection, payables collection, inventory days, those are days. You actually get the answer in days, like 300 days or 20 days or something like that. So these are efficient ratios. So there are 4 efficient ratios. There is your debtors collection, which represents how long does it take you to collect money from your debtors, which you get in days. There's payables, a payment period, which indicates how long does it take you to pay your creditors, which you get in days. There's inventory days, which represents how long does it take you to sell your inventory, which you get in days. And then there's inventory turnover, which you get in times. So inventory turnover, you're basically asking yourself, how many times do I buy inventory? Or how many times do I run out of stock? So think of it this way. Let's say that you are selling Bibles, like you're selling Bibles. So at the beginning of the year, you go to a wholesaler and you buy 50 Bibles, right? So during the year, as you sell your Bibles, you might take the whole year to sell your Bibles from January to December. So that means that you only had one turnover of inventory, which means you only sold one lot of inventory. But let's say that you sell your Bibles, by June, you've sold all 50 Bibles. You go back to the reseller and you buy another 50 Bibles, and by December, you've sold them, which means you've sold 2 lots of inventory. You've turned your inventory 2 times. So that's exactly what this is saying. It's how many times per year am I selling out the inventory that I have? So that's inventory turnover. So it represents how efficient am I as an organization in selling the product that I am selling. The higher this ratio is, usually the better. But like I said, usually the higher, the better. But just think of it this way. If my inventory turnover was 365, which means that every single day I am buying new stock from my supplier, you would start asking me questions. I don't think you're managing your business properly. Because remember, it takes time for me to go to the wholesale, to buy more Bibles, to come over here, sell all of them, and then go back tomorrow again. What am I doing with my business? I might as well just ask the wholesaler, can you give me more? Instead of giving me 50, maybe give me 1,000 Bibles so that at least I don't run out in one day. I can have at least a week and then come back after a week. So a high inventory turnover does not really mean that you're doing good business, especially if it's too high. It just means that you're not buying enough products. That's what it means. You're just not buying enough products. So there is a caveat. Although you don't want an inventory turnover that is too low, you also don't want an inventory turnover that is very, very high. So it's difficult to interpret. It just depends on how. It just has to be average. Let's just say maybe it has to be between 4 and 10. Let's just say that. It has to be between 4 and 10. Anything less than 4, it's too low. Anything more than 10, it's too high. So you it's just an average, my own opinion, but you can have a difference of opinion. So that's inventory turnover. But if you're looking at ratios, for example, such as debtors days, you want it to be very short. You want people to quickly pay you your money. So data's collection, it has to be very short for it to be a good ratio. If you get a ratio of 2 days, that's good. If you get a ratio of 100 days, that's bad for data's collection. But if it's payables, payment period, you want it to be high. You don't want it to be too low. If it's 1 day payables payment, it means you are wasting your opportunity as a business. You want to pay your suppliers later than earlier. So that's what I'm saying, that it can then become a little bit tricky for efficient ratios, whether a high ratio is good or a low ratio is good. It depends with what you are calculating. Be guided by the information that your lecturer has provided. So for example, in this particular case, let's see. I didn't provide any information here. All right, anyway, it's fine. So what I wanted to say is, for example, if you are calculating your data's collection ratio under your your efficiency ratios, your lecturer can tell you that the credit terms of the organization are 30 days. He might say that the credit terms of the organization are 30 days, which means that if your ratio is more than 30 days, it means that people are not honoring the credit terms. Remember, credit terms means what we agreed when you're going to pay me my money. We agreed that you're going to pay me in 30 days. So if you pay after 30 days, that's bad. So if I calculate a data's collection in this more than 30 days, and we agreed that you should pay me in 30 days, it means that I am failing as a business. But if I calculate and I get 28 days, it means I am doing good as a business. So what about payment period? Your supplier's payment period or your creditor's payment period. So your supplier might say, can you pay in 90 days? So if I pay in 1 day, when he says 90 days, it means I am wasting my resources. I should use that money for something else and wait for the 90 days. So that's why I'm saying that it becomes the opposite now. Because for supplier or for creditors payment period, you want to match exactly. If he says 90 days, you want your ratio to be as close to 90 days as possible. If it's more than 90 days, it's a problem again. Why? Because your supplier can sue you for not paying within the payment period. Right, so that's your efficiency ratios, right? And then you've got your debt to assets ratio. Okay, so what other tricks are there on this one? Okay, let me just explain a couple of tricks there. Let's see, do we have another ratio that we're going to calculate later on? No, it's fine. I'll explain it when we do the creditor's payment. There are some tricks that he might pull on you. But I think this one I explained, the trick usually is your ability to know what is the average inventory, which is the opening plus the closing divided by 2. That's the trick usually there. The other trick is on the other ratio, the creditor's payment. We will do it when we get to it. All right, debt to assets ratio. What's the formula from our total debt divided by total assets, right? Multiply by 100. All right, sorry, I just got distracted there. Total debt, question number 4. All right, our total debt is going to be our trade payables there, which is 900,000, plus our company tax payable, which is 60,000. Then if we had long-term loans, we would also add them. But in this particular example, we don't have any long-term loans or debentures or bonds, so we can't add them. But if we had any long-term loans, we could add them because total debt means both the current and the non-current debt. All right. Divided by the total assets, which is 11,160,123. Right? Multiply by 100. Right. So we get our answer of 8.60%. So what does this mean? This means that the total assets of the company were funded or were paid for by 8.60% of debt, right? Which means that if I take 100 rand in the assets of the organization, 8 rand of that was financed or was paid for through debt. This is a very low ratio. It's not very high. It's very low, which is good. Usually, we say a debt ratio below 50%, it's good. If it's above 50%, it's a problem. Because if your debt ratio is above 50%, it means that more than 50% of the items that you have or of the assets that you have to pay them through loans, right? But here, it means only 8% of what you have was paid through loans, which is very, very good for an organization. So when you're looking at debt ratios, usually the lower the debt ratio, the better. I use the word usually because there are some ratios such as interest cover, which can be interpreted differently. Right. But if you're looking at the debt to assets ratio, the debt to equity ratio, the capital gearing ratio, usually a low debt to assets, a low debt to equity, a low capital gearing ratio, it's a good thing for the organization. It means that you are not over borrowed as an organization, right? You are not over borrowed as an organization. Again, you can compare with last year, or you can just make a straightforward comment. Right, let's go to the next one. So that's your debt ratios there. So another debt ratio that is common is the interest cover ratio. The interest cover ratio, it just shows you how many times are you able to cover your interest or are you able to pay your interest. So let's say that your interest is 50,000 and you made a profit of 200,000. So your interest cover ratio will be 4 times. It means that you can pay your interest 4 times without making a loss. It means you can pay 50,000 once, 50,000 twice, 50,000 3 times, 50,000 4 times without making a loss. So that's the interest cover ratio. So the bigger the interest cover ratio, the better. But all the other debt ratios, the smaller they are, the better for the organization in terms of interpretation. Right. Then our next group of ratios, I don't think there's any trick here. The trick is just being able to know what total debt is, what equity is, right? If you know what equity is, you can calculate this ratio. If you know what total debt is, like I said, total debt represents both non-current and current. Total debt represents both non-current and current, right? But if you are calculating what is called the debt to equity, right? Debt to equity, you don't use total debt. You use long-term debt only, which means current liabilities are not part of that. So those are some of the little tricky things, but they are there in the formula. If you check, let's see here, under the formula sheet. Yeah, you see this one? This one over here that I'm highlighting, that's the debt to equity. You can see it specifically says non-current debt divided by equity, which means you're not using all of the debt, but only the part that is non-current. So it's very straightforward. All right, dividend per share. Dividend per share, you're going to say the dividends for the year. divided by the number of ordinary shares, multiplied by 100. Please, guys, this is not a percentage. This is not a percentage. This ratio, it's multiplied by 100, but it's not a percentage. You will see what I'm talking about. It was one of those ratios where people end up saying percent when it's not a percent. So let's see dividends. What are the dividends of the year? Interim dividends, 456, no final dividends. So our dividends are 456,000 divided by number of shares. The issued share capital consists of 1 million ordinary shares. So you see what I'm saying, that these things can be very easy because the information is there. Don't need to change anything. All right. So that's 456 divided by 1 million. And then multiply by 100. So your answer is going to be 45 cents per share. Right. So if you don't multiply by 100, you get your answer in rands. Right? If you do not multiply by 100, it means your answer is in rands. But most of the time when we do this ratio, we multiply it by 100. We multiply it by 100 so that we can get an answer that is in what? That is in cents, because that's how you interpret this ratio. Usually it's in cents. It could be even 100 and something cents per share. Doesn't matter, but it should be in cents. Right. So interpreting this ratio, of course, the higher this ratio is, the better, because it means that the organization is making what? Is making a profit. So you definitely want this ratio to be as big as possible. You can compare it with last year's ratios or not, but the higher this ratio is, the better for the organization. So in addition to the dividend per share ratio, you can also have the earnings per share ratio. The earnings per share ratio, again, is a very straightforward ratio. It's the net profit divided by the number of ordinary shares. Again, the higher it is, the better. Then you can also have the price earnings ratio. Now, that one is a little bit more complicated. Price earnings ratio. So price earnings ratio, you're going to take the market price and you're going to divide it by the earnings per share. But remember, earnings per share is another ratio, which means that if he asks you to calculate price earnings ratio, it means you also have to calculate the earnings per share ratio. So you're actually calculating two ratios instead of just one. So that's the little tricky part. Then the earnings per share ratio, if he tells you to interpret that ratio, earnings per share, we are just basically looking into the future of the company. If you've got a high earnings per share ratio, it means that your shareholders think that your organization is going to make a killing in the future. That's why they have a high earnings per share ratio. It just means that they think this company will make $1 million or $1 billion in the future. So they price it very, very high. So that's the reason why you can have a high price earnings ratio. It means people are confident in your business. It's good, it's bad, either way, but that's what it means. It just means people are confident in your operations as a business. Then the last ratio that we're going to do for today is the creditor payment. So creditor payment, that again under efficiency. The last one that we did, dividend per share, it's under shareholder ratios. So under shareholder ratios, you have dividend per share, earnings per share, price earnings ratio. Those are the ones that usually found under shareholder ratios. Then under efficiency, we said what? Inventory turnover, debtors payable, creditors payable, and inventory days. So now let's look at creditors payables or creditors payment period. So this one now, for the guys that are doing advanced diploma, this is why I want you guys to make use of the formula sheet, because it will help you. You might find that for the guys that are doing first years, your lecturer uses the ratio which says multiply by 365. But for the guys that are doing advanced diploma in business management, your lecturer will put a ratio that says multiply by 360. Both of them are correct. Don't ask me why, but both of the lecturers are correct. So make sure you double check with your formula sheet for your particular exam what your lecturer wants, whether he wants 365 or he wants 360. It will be there on the formula sheet of your exam. So in this particular case, we are using 365. Right? So accounts payable divided by credit purchases multiplied by 365. Right? So let's go. So there's a little trick on this one that you need to learn. So accounts payable, you have this information. It's not going to be a problem. Accounts payable, those are your trade and other payables. That's your accounts payable. So that's 900,000, right? Divided by credit purchases. If you check here, you are not given credit purchases. You are given cost of sales. So you need to calculate credit purchases. So divided by credit purchases multiplied by 365. So how do we calculate credit purchases? Right. So credit purchases, the first point that I want to make, which is very, very important, which you can make a mistake on. Some companies can buy some purchases on cash and some purchases on credit. So your lecturer might tell you that 90% of the purchases were on credit, which means that for you to calculate credit purchases, you are going to say 90% multiplied by the purchases. I want you to get this first before we go further, right? So it depends with the question, but let's check what this lecturer says. This lecturer says trade and other payables consisted of trade creditors only, right? Which means it concluded of trade creditors only. And then this statement here says all purchases were on credit, which means that I don't need to multiply for me to get credit purchases. My credit purchases are exactly my purchases figure because all my purchases were on credit. None of them were on cash. Right. Now, you might ask me, James, yes, you have told me that, but still I don't see where the purchases are. So how do I calculate these purchases that you're talking about? So how do we do this? Now, remember from our lecture from income statement, we said that cost of sales is equals to the opening stock, right? Plus the purchases minus the closing stock. I know I've skipped a lot of things there, but they're not there in this question. I don't want to confuse you. We said plus carriage on purchases, minus returns on purchases, and all of those sort of things that we talked about. But in this particular case, they are not there. So I'm going to remove all of them because they are not there in this particular case. So I don't need to worry about them. These are the only things that are there in this question. So cost of sales is equals to opening stock plus purchases minus closing stock. Do I have cost of sales? Yes. How much is my cost of sales? 5,304,000. 1, 2, 3 is equals to. Do I have an opening stock? An opening stock, that's my opening inventory. Remember, stock and inventory is the same thing. So what is my opening inventory? That's the inventory from last year, which is what? 2580,123. Plus purchases, I do not know, minus closing inventory, which is 2.1 from this year. Can I now calculate purchases? Yes, because I have the solution over there. So what am I going to do? 5,340,000, right? Minus 258. I'm now just doing algebra. Plus 21 is equals to purchases. I've just now used my algebra to solve for this problem that I have over here. So I can now put in my calculator, 5,304,123 minus 258, 2, plus 100, 1, 2, 3. Okay, yeah, that's correct. So which means I can now change my credit purchases figure here and say it's 4,824,000. And then we're done. I can now say 900,000 divided by 4,824,000 multiplied by 365. And then I get an answer of 68.10 days. So that becomes my answer over there, 68.10 days. So you can see, very straightforward process, right? So that's how you calculate your creditors payment period. And like I said, if you're talking about creditors, you're going to compare. If you're told 90 days, you're supposed to pay in 90 days. Therefore, they should come out to nearly 90 days. Anything lower than 90 days is not good for them. Anything higher than 90 days is not good for them. They have to pay within 90 days, at the exact 90 days usually, like a couple of days around 90 days. That's what we recommend for creditors payment period. Right, so that brings us to an end of the ratios that needed calculation. Right, so if you check question number 5, it then gives you here about 3 ratios and says, can you interpret these ratios? So that's 5.2. It gives you the return on assets. Do you see what it did? It gives you 2022 and 2023. It gives you earnings per share, 101 cents, 2022 and 2023. It gives you the current ratio, 2022 and 2023. And remember what I said, if you've got 2 ratios from different years, you can compare them. So remember, we said return on assets, that's a profitability ratio. So the higher the ratio is, the better. So you want this ratio to increase. So the fact that it increased from 2022 to 2023, that's good for the organization. So you comment, there was an increase in the ratio over the 2 years, which shows that the company was more profitable, right? Earnings per share, we say this is a shareholder ratio. And we say that the higher the earnings per share is, the better the organization. Earnings per share just shows you the profit made for each share in the organization. So they made a profit of 101 cents per share, and then it increased to 114, which is good for the organization. So again, you comment, there's been an increase in the ratio, which means that the company made more profit for each shareholder in the business. Current ratio, that's a liquidity ratio. What did we say? The higher liquidity ratio is, the better. But I said that liquidity ratios have benchmarks. If it's the acid test ratio, it's 1:1. If it is the current ratio, it's 2:1. So the first thing that we can say is both years, the ratio was above the benchmark, because the other ratio is 10, the actual ratio is 6.638, which is above 2:1. So which means both years the ratio was above the benchmark. So although the ratio decreased from 2022 to 2023, it is still above the benchmark. Yes, the company should double check, why did the ratio decrease? Maybe things are getting worse, but they are still above the benchmark, which is 2:1. So they are still okay because they are above the benchmark, but it definitely declined, which means that their liquidity is now worse off for the organization. So that's how you do your interpretation of ratios. Any questions, any issues? All right, so from next year, guys, we are doing revision papers. We are going through different past exam papers. If you've got a question paper that you think we should go through, you can send it in the group. I'm talking to the first years right now. From next year, Thursday, for the first years, we are going to be doing revision classes, because I know your exam should be early November, so we want to start preparing for those exams for the first years. Then for the guys that are doing advanced diploma, we still need to do a topic, I think, on Monday. We are going to be looking at budgets. We're going to be looking at cash budgeting on Monday, because we haven't done that topic on cash budgeting. So we are going to be looking at that topic, cash budgeting, on Monday, how to prepare a cash budget before we start on our revision. All right. Thank you guys for coming through. If there are no questions, we are dismissed. If there are questions, you can go ahead and ask before we dismiss each other.
Thank you, James.
Thank you, James.
Sharp. Good night.
Good night, James. Thank you.